Hello, everyone. Welcome to the week that was, the weekly podcast that sums up market movement and events from the past week and its implications on asset markets. I am Michelle Castellino, the host for this week's podcast. Last week, markets rose for the fourth consecutive week. Nifty and Sensex rose 0.3% each. Broader markets outperformed for the week. The week started on a strong note driven by optimism over India US trade deal amid positive comments by US Treasury Secretary on US China trade negotiations, as also improving domestic outlook amid the festive season. Upside was restricted as investors booked profits following sanctions on Russian oil and as Indian government did not confirm reports of a nearing trade deal with the US. On the sectoral front, the BSE IT index gained 3.9%, also driven by expectations of potential India US trade pact and easing trade tensions, which could positively impact the sector. Telecom and metal sectors also witnessed rally to the tune of 2% and 1.5% respectively. Bond yields rose across the curve as anticipation of a trade deal with the US dampened expectations of further rate cuts by RBI. 10-year GSEC yield rose by 2 basis points to 6.53%. Oil prices rose sharply by 7.6%. This was triggered by supply concerns owing to US imposing sanctions on top Russian oil producers. Gold prices declined after 9 consecutive weeks of rally due to anticipated US-China trade deal and expectation of a Fed rate cut. If we look at India's performance year to date, Indian markets have underperformed global peers, while global markets have rallied close to 19%. Indian markets have only delivered 9% returns. India's underperformance has been driven by tepid earnings for the past few quarters, stretched valuations, and persistent FII outflows. However, India's relative valuations have now improved. Valuation premium relative to EMs and Asia ex Japan is now significantly off historical peaks. With premium to emerging markets at 45% and to Asia ex Japan at 46%, both of these are significantly lower than last year highs of 82% and 91% premium, respectively. Most of the headwinds that I discussed of earlier now seem to be priced in, with earnings downgrade cycle bottoming out, with decent earnings recovery expected going forward, driven by a low base from last year, positive policy tailwinds, and improving macros. Given these factors coupled with improving valuations, we see a reversal in India's underperformance going forward. That's all for this week. Thank you for listening to our podcast. If you find this useful, please like and subscribe. Have a great week ahead.